Welcome to the deep dive. Today we're tackling financial valuation.
Yeah.
You sent over some really interesting material on, how you figure out what stuff is worth, stocks, buildings, even intangible things like patents.
Right.
So our mission today is basically to unpack those methods, pull out the key ideas for you.
Exactly. And the sources cover a lot of ground. We've got um, absolute value models looking at future cash flows,
Okay.
relative valuation comparing similar assets. We'll briefly touch on option pricing too.
And valuing physical things,
Yeah.
like property.
Yep. Tangible assets
Hmm.
and also intangible ones, patents, trademarks, plus how accounting estimates fit in,
Yeah.
and this thing called fair value measurement.
Sounds comprehensive. And
Yeah.
really, understanding this isn't just for finance pros, is it?
Not at all. I mean, if you're looking at an investment or just trying to understand a company's health or even just curious, these concepts give you a framework.
Okay, let's start with absolute value. The
Mhm.
core idea seems to be money now is better than money later. Present value.
That's it, exactly. Present value.
Yeah.
A dollar today isn't the same as a dollar next year because you can invest today's dollar.
Right.
So we have things like annuities. Those are steady payments for a set time.
Mm-hmm.
And perpetuities, which theoretically go on forever.
Like infinite payments.
Sort of, yeah. And for a simple perpetuity, the value is just the annual payment divided by the required rate of return.
Okay.
So like if Baker Corporation has preferred stock paying a $5 dividend and you need a 20% return.
You divide 5 by 0.20.
Exactly, gives you $25. That's the value based on that perpetuity idea.
Got it. But most stocks, hopefully their dividends grow.
Hopefully. And that's where the dividend discount model, or DDM, comes in, specifically the constant growth DDM.
Okay, how does that work?
Well, the formula is P0 equals D1 divided by R minus G.
Whoa, okay, break that down.
Right. P0 is the price today. D1 is the dividend expected next year. R is your required return.
Which we might get from something like CAPM.
Often, yes. CAPM helps figure out that risk-adjusted return. And G is the constant growth rate of the dividend. Forever.
Forever is a long time. Big assumption there.
Huge assumption. And R must be bigger than G, otherwise the math breaks.
So, back to Baker Corp. If the current dividend, D0, is $5 and growth G is 4%.
Then D1, next year's dividend, is $5 times $1.04. So $5.20.
And if R is still 20%,
Then it's $5.20 divided by 0.0 minus 0.04, which is 0.16.
so 5.20 divided by 0.16 gives you $32.50 higher value because of the growth.
Precisely. And DDM is just one type of discounted cash flow or DCF analysis. You can do similar things with free cash flow or residual income.
Okay, so that's looking inward at the company's future potential. What about looking outward? Comparing?
Right, that's relative valuation, using multiples. You compare a stock's price to some fundamental metrics.
Like the PE ratio, price to earnings.
The most famous one, yeah. Price per share divided by earnings per share. You can use past earnings, that's trailing PE, or expected future earnings, forward PE.
So for Baker, if its forward EPS is $2, and similar companies trade at a PE of, say, 7.5.
Then 2 times 7.5 suggests a price of $15. It's a quick comparison.
And there's the PEG ratio, too,
Yeah.
PE divided by growth.
Yep. Tries to bring growth into the PE comparison. Lower PEG is often seen as better, like you're paying less for each unit of growth.
Makes sense.
And you mentioned others, price to sales, price to cash flow, price to book. Same idea, different metric. Divide the price by sales per share, or cash flow per share, or book value per share.
So for Bolden Corp, with its $18 stock price and $120 book value equity over 10 MR shares,
Right.
that's $12 book value per share.
Right, so the PV is $18 divided by $12, which is 1.5x.
Quick checks against peers, but relies on finding good comparisons.
Definitely. And assumes the market is pricing those peers correctly. These are useful, but not foolproof.
Okay. Your sources also mention other things briefly, option pricing.
Yeah, models like Black-Scholes or Binomial, they get pretty complex, looking at stock price, strike price, time, volatility, different beast.
And valuing bonds or debt.
That's back to present value, really. Discounting the future interest payments and the final principal repayment.
What about, like, a building? Tangible assets.
Several ways there. Cost approach, what it costs to build. Market value, what similar ones sell for. Sometimes liquidation value, if you had to sell it fast.
And those tricky intangible assets, patents, brands.
Similar approaches, actually. Market approach, find comparable sales if you can. Income approach, estimate the future income it'll generate and discount it back. Or cost approach, what would it cost to recreate it?
It feels like there's a lot of estimation involved.
Oh, absolutely. Even basic accounting involves estimates, think allowance for doubtful accounts or depreciation. That all feeds into valuation.
And fair value, that sounded specific.
It is. It's an accounting standard.
Yeah.
Tries to estimate the price an asset would fetch in an orderly market transaction between knowledgeable, willing parties, uses market, income, or cost approaches, and ranks the reliability of the inputs level 1, 2, or 3.
Okay, wow. So wrapping this up, valuation isn't one single number.
Definitely not. It's a toolkit. Different tools for different assets, different situations. You're either estimating future benefits or finding comparable worth. And assumptions are key.
Really seems like a blend of art and science.
It is. Which brings us to a final thought for you to consider. Given all these methods, discounting cash flows, comparing multiples, assessing costs, what do you think is ultimately the most important factor when you're trying to figure out what something is truly worth?
Right.
Is it the cold, hard numbers? Is it market psychology? Or maybe something else entirely?